Good morning, folks. Thank you so much for joining us for today's episode of Be the Bank, the FIXnotes show on the distressed secondary mortgage market. I'm so happy you're here to discuss pricing distressed debt and how to analyze and value first position loans, second position loans, performing and reperforming loans on today's episode of Be the Bank. But before we get started, I want to thank all of the new signups on FIXnotes.com/buy. We had 12 investors in the last 7 days. Go to FIXnotes.com/buy to sign the non-disclosure agreement. It's totally free so that you are authorized to review mortgage notes for sale on our available inventory. So thank you so much. David, Michelle, Sandeep, Aliana, Omari, Royal, Tim, Jure, Will, Susan, Jason, and Jerry. Everybody except for 2 of you have already executed the non-disclosure agreements, which are emailed to you via right signature. So the 2 that I'm still waiting for are from Susan and Jire. Please get on over to your inbox to sign that right signature document. So without further ado, let's get into the show. To make sure my intro stinger transition is off, and let's do it, guys. All right, it's episode number 17 today. Very excited to present pricing, first, seconds, RPLs, and MPLs in our overview of the industry. Then we're going to be talking tech, as always. It's a laptop and a phone business, which is one of the reasons I'm sure you're excited about the note business. And then asset acquisition opportunities. We're going to talk about the loans that are available for sale right now. Then some case studies. We always present 2 case studies on this show. Every single week we have brand new case studies to share with you. And then of course giveaways for those who subscribe, comment, and like this video. So without further ado, well, there's one more ado, because every week we have to draw your attention to FIXnotes.com/learn, where you can just review an entire free course of everything you need to know to get started in this business. It's very well organized into a bunch of different modules and subsections, from everything from getting started in the glossary of understanding all of the terms you need to know, to asset management, due diligence, and resolution strategies. So super cool. FIXnotes.com/learn, 100% free. I would highly recommend you guys check that out. Good afternoon to you, Rakesh. Thank you for commenting. And guys, if you have any comments at all and you're tuning in live, you can leave them in the chat and I can address them if there's any clarifications necessary or anything that you maybe want some more explanation for. So, industry overview. Today's all about pricing, but of course you need to understand the news, the industry goings on that are happening lately. So you can find that out on FIXnotes.com/news, another free resource for this industry. I use an RSS aggregator to collect all of the high quality, timely information that I'm finding around the internet, and then I aggregate that all on the website. We've actually got 4 or 5 articles now already published for October, so you can definitely check that out. We want to talk a couple of events before we get into pricing. We had actually this just happened, the Paper Source seminar. Rakesh, how was it? I think Rakesh did attend the Paper Source online seminar, so I'd be interested to hear if you got some value out of these speakers, and there's a whole bunch of great industry contacts that I've done business with at that event. And actually, Paper Source was one of the first conferences that I went to, I don't know, 7 years ago in Las Vegas. We went out to the Tuscany, and for a couple years, that was the annual event where all the note investors got together. Now we're online, so I guess we're always connected these days. But I hope that was a great event for those who attended. The next event that's actually coming up is this Saturday, guys, the Distressed Note Convention, also an in-person event in Newark, Delaware, or Newark, New Jersey, my apologies, that is now moved online. So I'm actually an attendee and a speaker at this event, so I will be very much looking forward to seeing you guys there. And Rakesh says it was totally worth it, the Paper Source event. Good to hear. And that event, Paper Source, was $100, I think. This event is $100 for full access to get all of the content, or free to participate in some of the content. So I did get the preliminary agenda, and Nick, the organizer of this event, did create 2 sessions for me. I'm pretty honored actually to be presenting twice at this conference. Once in the morning at 10 a.m. I'm doing the in-depth senior versus juniors. You guys have heard that on the show, but maybe we'll add a couple case studies and really dig into seniors versus junior liens. And then in the afternoon at 1:50, or sorry, no, that's not right. At 2 o'clock, I'm doing Earn While You Learn, and that was episode 15, I believe. Maybe 13, I don't know. We did do this episode previously, so I'm gonna kind of put a new spin on it and represent that information for this group at the Distress Note Convention. So bring your questions. If there's anything that you were thinking when you're watching the show on YouTube and you want to get a little bit more clarification, join us for that. I believe that's part of the free sessions for the Distress Note Convention, but I may be wrong. In any case though, go check that out. All of the links for these events are in the description below so that you can see what the pricing is and get signed up. Here's another event happening October 13. This is from IMN, another virtual event for NPL Notes and Default Servicing Forum. IMN puts on some really great events, and they've done a good job of transitioning to this all virtual world that we live in now by including some forums for the attendees to network with each other in between sessions. So they tried to recreate that in-person event feeling online. So that's going to be a great event, and here's the preliminary agenda for those sessions. So a bunch of great presenters at this event as well. Highly recommend you check it out because it's 100% free for attendees to join. So I would highly recommend checking out the IMN virtual event. Then we've got the Distress Mortgage Expo, October 16th and 17th. This is a paid event. I think it costs $2.99. A bunch of great speakers here as well, and they've definitely really polished their presentation on this event, which I'd expect it is a bit more pricey than the other events. That's distressmortgageexpo.com, link also in the description. All right, so one final event, November 6th and 7th, this is the Note Expo. So this is probably the most expensive event. It's actually $699 for tickets. I believe the early bird is $299 right now. And it's 2 full days of live virtual workshops. And this event has been going on for 5+ years and is also pretty polished. It's put on by Eddie Speed's company. It is more expensive, and it does feel kind of like an upsell into Eddie's programs. If that's what you're looking for, you could definitely get some value out of it, but be prepared for the pitch. But that's noteexpo.com, another event to hopefully do some networking and maybe tune into those sessions. All right, so we're going to get into pricing right now, and that begins, as always, with the non-performing waterfall evaluation, because the second decision tree in this process after determining secured versus unsecured is determining first versus second. But before we talk about that, let's just take a round the horn, see how our birds and our fish are doing. Starting with this feeder, we just missed a chickadee. I saw it out of the corner of my eye, but he pieced out quick. All right, other feeder, nothing at all. But you know where there's action? The koi pond. Well, there's a couple fish swimming around. So I hope that has lowered your blood pressure looking at the wildlife for a minute before we get into this content, the non-performing waterfall evaluation. So right off the bat, pricing, since we're talking about pricing, we do have to mention unsecured debt, because unsecured loans they have a value. Everything does have a value unless it's totally unenforceable debt. But unsecured loans are enforceable just through the personal liability of the promissory note. Once a borrower has lost the collateral, the property, through a tax foreclosure or a senior lien foreclosure, here's a guy for you. He's on the other side. We can hardly see him. Once a borrower has lost the collateral to a property, the debt that you hold that was secured by that collateral is now unsecured. So you can pursue it through the note, but you can no longer foreclose or enforce your lien position through the collateral. There is no lien position anymore. There is no lien. It's been wiped. It's now unsecured. So most recently, I sold a portfolio, a package of unsecured loans that was cherry-picked by an investor and priced out at 1.9% of the unpaid principal balance. And as you see here, the range is about 50 basis points, which is 1/2 of 1%, up to maybe 5% of unpaid principal balance. And unsecured mortgage debt does have a lot more value than unsecured credit card or other types of accounts receivable, because these borrowers did originally qualify to get a mortgage, which typically requires a higher FICO score, lower debt to income, and potentially they may have other assets. So pursuing unsecured debt is an option, but it's not really the focus of this program. We talk about secured debt because I believe that that's where you can create the win-win resolutions with borrowers to resolve the debt while also helping them out of a tough situation. So once you've confirmed that it's secured by determining that the borrower that you're seeing on your data tape, your spreadsheet of loan information, matches the county records, ownership, whoever actually is holding the deed to that property. You can find that out from various services like First American Data Tree. You can review the county records to get the property owner. The assessor, the county tax collector's records sometimes will have the name of the borrower and also their mailing address, so you can see if the property is owner occupied. But once you've determined that the borrower still owns the property, it is secured, then it becomes this decision between firsts versus second liens. And you guys know I prefer second liens, but there are some advantages to both sides of the equation here. But pricing, because that's where we're going to hone in, starts in these pretty wide ranges. For first liens, 5% of the property value up to 85% of the property value. Whereas second liens, 2% up to about 60%, sometimes more. And even in seconds, it's funny that we have a pricing range that is lower than the potential high end for unsecured debt. And that's because some second liens, and I've heard this from a lot of investors, they call a secured second lien, it's still owned by the same borrower, the property could be foreclosed upon, but because it's so far underwater, they call it unsecured. Now that's kind of a misnomer because it's not technically unsecured, it is still a secured debt, but what they're saying when they say it's unsecured is that there's no equity that's remaining above the value of the first lien to secure their second position lien. So in those situations, you can have second liens that are almost priced like an unsecured debt in that 2, 3, 4% single digit range as a percentage of UPB. Now you'll see right off the bat here that we're calculating first liens based on value and second liens based on the unpaid principal balance. And we'll talk about that in the next slide, which is my Q4 pricing update. But just so you understand, it's because first liens are typically resolving through the property, and that's the value. The collateral value is so important if you're going to end up taking back that home. Whereas second liens resolve more often than not through the borrower. So you're really addressing the unpaid principal balance in those situations. Now the next step in both first or second liens is the equity. You need to determine the value of the collateral and then the subsequent equity that's available to the second lien. Another misnomer here is investors will look at equity as a combined loan to value calculation, CLTV. So when they see a CLTV above 100%, that's the first lien plus the second lien divided by the property value, they'll think that it's totally underwater and maybe there is no equity. But when we're looking at loans from a second position perspective, we want to look at the invested capital to value, the ICTV. So instead of combining both of the loans, you take the purchase proceeds that you would be acquiring the loan for, the amount you pay for the second lien, plus the balance of the first lien divided by the property value. So what that does is gives you a perspective from an investor's stance. If you're looking at the combined loan to value, that's the borrower's perspective of the equity in the deal. But as an investor, in the second position, all of that equity above the first position lien is available to the second lien holder. So we'll look at something like invested capital value or just loan to value from the first lien divided by the property value to see how much available equity is above the other liens. Now, after you've calculated value and equity, you want to stratify the values for first liens into value bands, into different tranches of property value. So these value bands can be defined however your model refines it to be, but just to begin with, I would focus on $10,000 to $15,000 value bands. So less than $10,000 properties are priced as a percentage of that fair market value very, very low. These are properties that are either vacant land or condemned or potential demolitions, properties that are sometimes more of a liability to own the debt on than an asset. So with those lower value properties, you're talking of a percentage of value of 5, 10, 15% of that value. Whereas when you get up the range, so $10,000 to $25,000 properties, are going to have 20 to 40% of the fair market value valuations. When you go up higher, 25 to 50,000, it increases further. So when you get up to that 50 to 100 and then $100,000 plus collateral value, that value band is a lot more valuable, a lot more, I guess that's self-explanatory. But as a percentage of the fair market value, the percentages are a lot higher in those higher value bands. And it's because really, those are the accounts that have a borrower who's more committed to the home. The property has value to them. They hopefully are still owner occupying those properties, and they're not quite as dilapidated as these lower value band homes. So it's interesting to look at value band, but there's so many other considerations to make, especially when valuing first liens without considering the unpaid principal balance. So if you look at this just from a very myopic focus of just property value, then you're going to miss the fact that the unpaid principal balance at the end of the day is what you're buying. So make sure that you include a UPB cap. I would say with first liens, you wouldn't want to pay more than 80–90% of the unpaid principal balance. If in those cases the property value does need to be pretty strong to support that type of purchase. But sometimes when there's a huge amount of equity, let's say the UPB is 10 grand and the property is worth 50, where it's pretty much a no-brainer as far as the borrower paying off the debt. They could sell the property, they could short sell the property, which would be unlikely with such a low balance. But there's many options when there's that much equity, and the borrower and the lender in those cases are really on the same team to resolve the debt, sell the property, or in some way resolve it so that the borrower can move on. Once you've calculated value and equity, very important for seconds because the first lien is going to be ahead of you, you want to look at the bankruptcy. So bankruptcy is researched through pacer.gov, pacer.gov. Pacer is public access to court electronic records, and that's going to be where you can learn everything about a borrower's legal and not foreclosure legal proceedings, but lawsuits and bankruptcies that borrower may be involved in. So bankruptcy is kind of a little bit scary for a starting note investor because it does put a little bit of a wrinkle in the typical process. You have to work through the courts. There's going to be filings that are necessary, and you definitely want to have an attorney on your team when a file does go through bankruptcy. But it's actually pretty good news because what a bankruptcy does is opens up that borrower's financial records for the court and then subsequently the lenders to see what's actually going on. So when you review a voluntary lien position, voluntary petition. A voluntary petition is the first document that borrower will file that has all of the schedules and the claims of different assets and liabilities. So as a secured lien holder, you'll want to look at the Schedule D, which is the secured lien schedule, which will give you the value of the property that the borrower has claimed, which a lien holder may need to dispute with their own broker price opinion. And they'll also give you the principal balance of the debts that are secured by that property. So by looking at the Schedule D, it really gives you all of the information you need about how much equity is left for your lien and if there's going to be an uphill battle collecting the debt, or if it's pretty much cut and dried and there's enough equity to pay off your lien and just go through the process with the court and eventually start making those bankruptcy payments. So super important to look at that voluntary petition, but also important to look at motion for relief from stay. So when a bankruptcy is filed, there's what's called a stay, which holds any foreclosure actions from proceeding until that borrower's bankruptcy has been finalized. But a lien holder, you as a junior lien holder or as a senior lien holder, can file a motion for relief from stay, which will relieve that pause, that hold on foreclosures, and allow a lien holder to pursue the foreclosure on the subject collateral, even though the bankruptcy is ongoing. So as a junior lien holder, you want to make sure that the senior has not filed that motion, or else you're racing against the clock at that point while the senior is pursuing that foreclosure against the property. After bankruptcy, occupancy is really important to understand. And really, occupancy could be up here near the beginning because there's a lot of easy ways to triangulate the occupancy status of an account. A few ways I already mentioned on this call was the property tax records. So when you look at a borrower's property tax record, you'll see the owner name and the mailing address associated with that account. Now, if the mailing address matches the subject collateral, then you can be pretty confident that that property is owner occupied. Whereas if the mailing address is different than the subject property, then you know it may be tenant occupied or maybe even a vacant home. But in any case, the borrower is living somewhere else. Another data point you can triangulate for the occupancy is the credit report. Credit report will have up to 3 different addresses, with the first one being the current address that that borrower is currently residing. So that's another data point. You plug in every option you have of these different potential occupancy statuses, and then you could triangulate based on those positive hits or negative hits, and you can start to come up with a picture. Because you don't want to trust just one source. You also want to, in addition to property taxes and credit reports, you could potentially do a skip trace. A skip trace is a more in-depth review using utility records, other creditor records to determine whether or not that property is occupied. So that's probably the most effective, short of having a door knocker sent out. A door knocker is someone who serves a borrower paperwork at their property and really can only be applied once you own the debt and you're the lender and you have a servicer and everything's set up. Door knocking is not at all advised or permissible for a due diligence process for an investor who's going to buy the loan. That needs to be done once the loan is acquired. But that is going to be the end-all be-all way to know who's living in the home, is actually have some boots on the ground to knock on the door. After occupancy, we have another little decision tree. We go to title and taxes for first liens, first status, and equity for second liens. So title reports, I would highly recommend ordering for first position liens because title is way more important, I believe, when you are a first lien holder, because the taxes, mechanics liens, other things that could jump in front of you are going to be solely your responsibility as the first lien holder. Whereas in second position, you've got that first lien holder ahead of you. And typically the first lien holder is going to be handling those issues before they arise for your second position debt. And what I mean by that is if a tax foreclosure is initiated by the county, the first lien holder is the first one who's going to lose a deal through that tax foreclosure. So they're going to be the ones who are going to reach out to the tax claim, make those tax payments, bring the account current, and make sure that it's not going to be subject to a tax foreclosure. And typically, since first liens, like 95% plus of first liens, escrow taxes and insurance, you're going to have those proceeds set aside to pay off the property taxes from the first position lien holder. So really, when you're buying a second lien, if the first position debt is performing, if it's current, then you're in a really good spot with regards to title. And I wouldn't suggest ordering title when you're buying second liens behind performing first liens. I do think that title is important in some second lien situations. If you're paying more than $10,000, $20,000 for a single asset, $100 for a title report is probably a prudent decision. But for the most part, my clients are buying larger packages of loans, so we're reviewing title on just that high caliber, the top tier of first liens and some of the second liens. Now, we'll stay on the first lien side after title with taxes. And I mentioned this already, but taxes are the most important. It's kind of like in junior position looking at the status of the senior. When you're in senior position, you're looking at the status of the taxes to determine the borrower's intentions with regard to the property. So taxes, super important to understand in first position because that's what you're going to be potentially wiped out by in a tax foreclosure. And then on the other side, equity, and we already mentioned this at the top, but equity at the end of the day is going to be what drives your second lien pricing discussion. Hey Scott, thank you so much for joining us. I had a conversation on the phone with Scott yesterday about due diligence process for firsts versus seconds, and I did advise Scott when he's buying sub $5,000, $10,000 purchase price second liens that title is sometimes overkill. And really, when you're first starting this business, you want to build a core competency in some of these due diligence areas. And what an abstractor is doing when you order a title report or an O&E, they're going to the county record and they're reviewing the deeds and the mortgages and the assignments and the satisfactions and the lis pendens and other notices that have been filed in the county record. So as a note investor, you can build that competency yourself by looking at the public records at the county level to basically be your own abstractor. There's actually a really great video on YouTube, and maybe I should add this to the link below. I just thought of it, from, what is his name? REItipster.com. Real estate investing tipster, and he has some great, his name's Seth, and he has some great videos, one of which I think is maybe his most popular video on YouTube, is how to pull your own title report. And he kind of goes through the process of looking at county records to determine what liens may be ahead of your potential purchase when you're doing your due diligence, or when you've already owned a loan, how to determine whether or not a first lien is going through that lis pendens foreclosure process. So super important to understand the equity position from the second lien status, and that is the biggest driver of price in second position debt after the senior status. So first status is whether or not the senior is paying or not paying or going through foreclosure, but then whatever is above the balance of that first lien is the equity available to the second position lien. So the best case scenario is a junior lien secured by a performing first lien with positive equity protecting that lien position. And as you go through the worst quality first lien statuses and the lower equity position loans, that's how pricing goes from that 60% of UPB number all the way down to even as low as 2% of the unpaid principal balance. Yeah, pleasure to Rakesh. Seth, he's got a lot of great content, and also he's pretty niche into land investing and vacant land deals, which we've got a lot of vacant land notes at the moment in our inventory. So I think you can build a little bit of that knowledge base by looking at Seth's content, because it's based on actually acquiring the land, the REO. So we're pre-REO in the note business, and there's definitely some advantages, well, tons of advantages for us as lien holders, as note investors, that can give you kind of a leg up on investors like Seth who are buying the land in a traditional sense. All right, so we've went through the whole non-performing waterfall evaluation. We sometimes focus in on one specific aspect and really drill in, but today we're going on the overview, just to explain at a high level how to price first versus second liens. So let's get on to the performing versus non-performing, senior versus junior grid, and update that for the fourth quarter. Because the market pricing does evolve over time. I think the note industry is insulated from the general real estate industry in a lot of ways, so pricing moves a little bit slower. But at the end of the day, note investing is related to the underlying collateral, and the trends that you'll see in the regular real estate market will eventually hit this side of the market, the distressed debt business. So let's start out in the top here, performing senior liens. There hasn't been a change with cash flowing debt, and the reason is I don't have enough data to make any inferences here. We have not sold any reperforming loans, maybe one reperforming loan this year. So these ranges are pretty standard, and what I'm still seeing, since I don't have anything to refute that. And on the senior lien side, that's about 7.5% yields to 12.5% yields. These are cash on cash returns. So basically the monthly payment of a senior lien, net of any servicing fees, annualized, divided by 0.075 to get the low end of the value for that specific asset, up to 0.1255, you're going to turn these percentages into decimals, and then take that annual net income on the loan divided by 0.1255 to get the higher end yield expectation. And really these are reversed, because if you're buying a loan with a 7.5% yield, you'll be paying more than if you were buying a loan with a 12.5% yield. So interesting to understand, cash flowing loans are priced based on yield. And at the end of the day, that's how I believe that real estate investing should be done. You can't price based on speculation or based on events that may or may not happen. You really need to be pricing assets based on the cash flow that they generate. So when I buy rental properties, for example, I need to make sure that the debt is serviced. If I have a fixed rate loan, that the rent comps fully support, and then add profit on top of that, the amount that I pay for my debt. And then you can't really go wrong there, because for the most part, whereas real estate can fluctuate in values, rents can be a lot more stable for the most part. Who knows what's going to happen in the future, but that's my general philosophy on buying cash flowing assets. Junior liens, much stronger yields, 12% to 22% just about, and that's going to be really where I believe the sweet spot is, buying junior liens with equity, normally in these lower yield sections, but still higher than a senior lien, and you've got that added benefit of being behind a first position lien that's going to be escrowing taxes and insurance, protecting your investment in second position. So if we switch over here to the non-performing side, then we'll see that pricing, as we already discussed on the last slide, is based on fair market value in first position liens or unpaid principal balance in junior liens. And these numbers have changed because I've done a lot of deals in this past Q3 in these both tranches, non-performing firsts and non-performing seconds. So pricing has actually decreased just a little bit. We're talking about 1%, 99 basis points of decrease on the high end in seniors, 112 basis points on the high end in juniors. And that's just kind of a general feeling that I'm seeing in the market. Now, it's not to be gospel here. There's definitely different sellers who have different motivations, different specific situations that are allowing them to sell for a lot less or potentially ask for a lot more. Every asset is different. So, your due diligence is really going to define where you fit in these ranges. But at the end of the day, seniors are going to be priced based on that fair market value. Juniors are going to be priced based on the unpaid principal balance. And that's how you're going to get to the next step, which is putting your portfolio together and pricing out a bid. So I've added a new slide today for bulk versus one-off. And these are considerations that you need to make as you are reviewing loans for purchase. So we're going to talk about one-off purchases first, and I'm defining that as less than $100,000 of acquisition. So you could be buying $500,000 worth of debt, but $100,000 is the spend here that we're defining as a one-off, a more retail purchase. So these are retail pricing. Competing buyers in this area are less sophisticated for the most part. You're going to be competing against local investors who can probably pay a lot more for their specific market. And you as a one-off investor are paying more for the opportunity to cherry pick and to be able to diversify intentionally. So I say one-off as in like buying one asset at a time, but really this is cherry picking individual assets up to that $100,000 purchase price. So diversification is intentional when you're targeting specific loans. You don't have to buy a loan that you don't think is viable. You're really just cherry picking specific assets that fit your needs as an investor. So one-off purchases do offer some advantages. At the end of the day though, you're a little bit less optionality when you buy at retail pricing. These are really deals for end users only. You need to have that resolution with the borrower as your goal. If you're trying to buy loans, cherry pick assets, and then flip them, you're not going to do well. And at the end of the day, you're causing more friction in the resolution process. At the end of the day, the sales and trading aspect of this business is about getting a loan in the hands of an investor who's able to get that resolution done. So by delaying that process, by trying to flip loans, you're just slowing down the resolution at the end of the day. Now, I think trading can be important if you're buying a larger portfolio and then identifying specific investors who are local to certain markets and have more expertise in specific segments of your portfolio. But when you're buying one-offs, buy for your own portfolio and be that end user. There are standard reps and warrants for one-off purchases. This is your protection on your purchase sale agreement. The items that the seller is identifying as requirements for the deal. If those representations and warranties aren't fulfilled, then you have a claim as a buyer of a note to request a repurchase, to refund the loan because it was misrepresented. So anything that happens pre-cutoff date, so for example, if you're looking at a loan that's secured in second position and you're about to close the deal, and let's say you close it October 7th, you did your due diligence a couple days ago, but on October 6th, the day before you fund the deal, the day before the cutoff date, the loan is foreclosed and is no longer secured. That would be a repurchasable event because as of the date of the cutoff date is the date of funding in most cases. As of that date, the loan was no longer secured. That's on the seller. You can refund that asset. But if it happened the day after your cutoff date, unfortunately, you'd be out of luck. So that's why your due diligence process is super important. Now, some things in your reps and warrants that you can't really control that are very important to review there are documentation and the enforceability of the debt. So if the seller is not representing and warranting that they have complete documentation, the full chain of assignments, the full chain of allonges, the notes and the mortgages necessary to enforce that debt, you wouldn't know until you get the physical collateral package that they have all those original documents. Now, you don't need every single document to be original. For example, the mortgage is a publicly recorded document that's been entered into the record. It doesn't have to be original. That could be a copy or a certified copy. But the note does need to be an original wet ink agreement, a promissory note with the borrower. If it's not there, there needs to be a lost note affidavit that's executed by the previous lender, notarized and official, to replace that missing note. So I do find it concerning when you are seeing a purchase sale agreement that doesn't represent and warrant that the documents are in place, because it's one thing that you cannot review as an investor in due diligence because you don't have access to those files. Now, one way that sellers will get around that is with a bailee letter or with an escrow agreement. And that does introduce a third party to verify the validity of the documents before the deal is completely executed. So that would be the only exception, I would say, to getting these full reps and warrants, specifically with regards to collateral documentation. If you have a third party who's in place as a bailee or as an escrow agent in order to review the documents before the funds are released to the seller. Now we shift over to bulk acquisitions here. And this is going to be, in my definition, $1 million plus purchase price. And there can be some exceptions. A $500,000 trade is definitely going to have some more advantages pricing wise over a $100,000 or less trade. But really, until you get to $1 million plus, you're not going to see the full advantage of the bulk acquisitions. But with those advantages come some caveats. So right off the bat, wholesale pricing is much better. The competing buyers are professionals. They're tight with their due diligence. If a loan is not a viable purchase for them, they're going to be discounting it. It's not going to be, for example, with a retail buyer mistaking their due diligence process and then bidding way more than they should on a property. That doesn't happen as much in bulk acquisitions, since the buyers that are competing with you are going to be professionals. Now, these are also diversified, but in a different way. Bulk buys are rarely cherry-picked, and basically what their sellers are doing in these cases are putting together a package of loans and offering it all or nothing. You have to take the whole portfolio, the good, the bad, and the ugly, price it all as such. So they're diversified because you've got a variety of different assets that are represented in the pool, for the most part, but at the end of the day, you did not choose those specific assets. You can choose based on your pricing which assets you're finding the most value in, but you will have to define and price each one of those assets at the loan level in most cases for a bulk acquisition like this. Now, there is some optionality for flipping some loans. When you're buying at wholesale pricing, you can have a little bit of meat on the bone left to do a non-performing loan resale to an investor who's specific to a certain geography, who has maybe a core competency in an area that you do not. So there is an opportunity, if you have a strong network, to take down a bulk acquisition and then split it up within your network to investors who are more suited to those specific assets. And we've done some deals like that with investors who kind of pool together into a consortium of sorts, and then we close the deal with one purchase entity, and then at the end of the day, the purchaser is going to split the loans between their network. That is possible and does provide some advantages for a seller, make it seamless, just one big transaction with one larger buyer, and gives the buyer a little bit more legwork, of course, to split the pool into all of their various counterparties, but it gives them a little bit more purchasing power and the ability to take down larger trades. So that's possible. Now, expanded preferences equal much more opportunity. And when you're taking down bulk acquisitions that are all or nothing, and you're taking the good, the bad, and the ugly, you might find that you'll have more success on some of the accounts that you didn't feel like would be real winners. So by opening up your preferences, not only the size of the trade, but also the available asset classes that you would tolerate and that you would be able to actually come to some successful resolution with, that will allow you to approach more sellers and get more deals done, because there's not just second liens behind performing first with equity, which is what everybody wants to find. There's plenty of other assets out there, and if you're just focusing on that one little segment of the market, you're missing out on a whole bunch of opportunity. And by the way, if your due diligence is inaccurate on the high end, you're pricing a loan and something happens or something comes up that you missed in your due diligence and it turns out to be less valuable than you thought, that's a lot of downside risk. Whereas if you're pricing loans that are already less attractive, there's some upside potential there. If, for example, satisfaction of mortgage on a first lien wasn't identified but is recorded and your second moves up to first position, or maybe the loan looks like it's senior foreclosure, but the foreclosure has already been dismissed and there's actually a modification or something in place with the first lien holder. So I think that expanding your preferences to these lower probabilities, lower value accounts, the pricing is going to be a lot more attractive and does leave a lot of room for the big wins. Not only when the due diligence was inaccurate and there's actually more upside, but also situations that have emotional equity or other considerations of the borrowers that don't look good on paper, but at the end of the day, the borrower's intention is to pay back that debt. So a lot of things that you can find out once you do start taking down larger portfolios blended with all sorts of different assets and kind of hone in on your specific niche. All right, so I think we're done here. Oh, we got one more. For bulk acquisitions and larger purchases, those reps and warrants are typically going to be negotiated, and the sellers are going to more often have as is, where is terms. And like I said, I did a big bulk deal with a consortium of buyers. I think that was at the end of last year. And that trade was as is, where is 100%. It was the tail end, so the remaining assets of a few different portfolios. The seller was looking to close out the funds, multiple fund entities, and move on to the next deal. So in order to close out those funds, they could not offer the standard reps and warrants that allowed for repurchases, because those repurchases would be liabilities lingering to delay the closing of the fund. So in that case, the pricing was very attractive and the loans were sold as is, where is in that bulk acquisition. So you get better pricing when you accept that type of risk. All right, so let's move on to reviewing reperforming loans. And I put together a modification viability calculator because I had a conversation with another investor this past week about how to define modification terms, how to come to specific agreements that are formulaic and also give you the most upside with that performing asset once it starts to cash flow. So let's swipe over to this spreadsheet. Here we go. This is the modification viability calculator that I put together, and it looks similar to the previous simple investment calculators, but with a couple tweaks. So let's go through it here, starting with the unpaid principal balance of the non-performing loan. So first you want to plug in these red fields, the unpaid principal balance and the percentage of UPB that that loan is selling for. And that's going to give you your non-performing loan value. Pretty simple. It's just the UPB times the percentage of the UPB. So that'll give you what you pay for the loan. Now, if we scroll through, you'll see some logic here. It's an if-then statement to identify whether a reperforming loan with the proposed terms is actually less valuable than the non-performing loan. So if we keep scrolling, we'll show you how to turn that lever. And that's based on the payment amount. So in this case, if we were receiving $498 per month, then as a sale of that reperforming loan, we'd be looking at a $29,000 value in the reperforming loan. And I'm being very, very conservative here because this is based on a 20% cash-on-cash return. So like we talked about in that pricing considerations and having those ranges, this would be a second lien with a pretty strong yield. And we're doing this conservatively because I think it's very easy to sell loans at a 20% yield if they have some seasoning behind them. There's some track record with the borrower making those payments. So I think it's only up from here. You can definitely get more than a 20% cash-on-cash return. So what you'll see here is that as we adjust the payment amount, and we'll keep the servicing fee at $15 a month just to have a net servicing or net payment amount that makes sense. But as we adjust this payment amount, you'll see the reperforming loan value change down here. So let's say that this borrower was only able to afford $250 a month. So right off the bat, we see the warning. And that's because the reperforming loan is only worth $14,000 at a 20% yield. So you bought the loan for more than it would be worth when it's cash flowing, which you don't want to go there. So when you're discussing this modification potential with a borrower, and even when you're doing your due diligence before you even acquire the loan, look at these numbers, plug in the numbers on the deals that you're looking at to determine whether or not a paying borrower would be worth more in this specific scenario than it was as a non-performing loan. And just the same, if the payment amount was greater, let's say they could pay $750 per month, you'll see that now the reperforming loan is worth $44,000, pretty close to the unpaid principal balance, and it still offers the investor a 20% cash-on-cash return. So play around with this. The link is in the description below, so you can download this spreadsheet. And I think it is. If it's not, I'll put it on after we get off the call here. But this is going to be pretty useful before you buy a loan or when you already own a loan to determine your minimum viable payment amount. Now, if the borrower could not pay, in this case we're at like $498, let's say it's $400, that's $23,000. So there's a little bit of room there still. We could kind of find our break-even point. It's more than $300, like $325 a month. Oops, not 3,000. $325 a month puts the RPL at about the same value as the NPL. That's a bit less than I would say is the minimum number here. But if the borrower can only afford $325 and there is a negative equity situation, and if there was a negative equity situation, you wouldn't pay 39% of the UPB right off the bat. But you can kind of determine where your break even is, so that if all else fails, this is where you can close the deal in order to get a return on your non-performing purchase price. And that's where we show up here. What is your cash-on-cash return at the proposed payment amount? So if you are being more aggressive with your acquisition strategy and you're comfortable earning 19.8% on your non-performing purchase, then that's a potential cash-on-cash that could work for you. Now, it's no guarantees because the loan is still non-performing. You're not totally sure if the borrower is going to be able to pay this or if this deal is going to work out. But it can at least give you some assurance of, especially in an equity position where the borrower either has two choices: work with you to sell the home, pay off the loan, or work with you to get a modification done. Then this does give you some clarity around the minimum amounts that you could accept as a reperforming cash flow. Down here, there's just the internal rate of return calculations so that you can compare both the cash-on-cash return with the internal rate of return. And that's going to be important because when you bring out a loan all the way through to the end of the term, those basically worst case scenario, it's funny how in the note investing world, sometimes the worst case scenario is the borrower just makes all of their payments as expected, and it's still a great outcome for the investor. This just shows you what would happen if that borrower just made every single payment as intended. Now, most of the time though, with scenario 2 having a refinance, an early payoff, and that means based on the amortization schedule, a payoff at that time, that would be a much higher internal rate of return. So that's a better case scenario than the borrower paying it all the way to maturity. So let me know if you have any questions on this. Download it, mess around with it, see if you can plug in some of your own deals, and make sure that you are requesting payment amounts in your options that you're providing to the borrower that are viable to you as a non-performing loan investor. So lots to explore there. Feel free to leave me a comment once you've reviewed it a little bit if you have any questions. All right, so let's go back to the presentation here and move on to tech tips. So there's so much that we can do with the internet these days, which makes this business possible to be run from anywhere with a capable PC and a Mac, a decent smartphone, and fast Wi-Fi or cellular connection, even a slow connection. As long as you can connect to the internet and communicate with your counterparties, you can run this business using these variety of different software and web services in order to make the business more automated, more efficient, and less manpower, less employees, less stress with that side of the business when the technology is doing your job for you. So we've really discussed every single one of these in some detail, but there's always more to review. So let me know in the comments if you have any specific areas you want to touch. But today we're going to be talking about Excel. We talked about Excel last week as well, but today we're going to be talking about pivot tables. Pivot tables are super important when you're reviewing a large data set. I think my camera just turned off here, so let me get that one back on, just in case you see a beautiful bird. We don't want to miss it. All right, so let's go over to, we're going to talk about assets for sale in a minute. Trying to find my spreadsheet here. Okay, so I have one more spreadsheet for you, and this is the latest sales overview. So these are all the sales that we've conducted, or the sales that are pending to be closed in this most recent offering. And what I want to show you here, and I'm going to give the full screen over to the spreadsheet here, and we'll zoom in a little bit. We'll make sure you guys can see what we're doing. I'm going to show you just pretty quickly how to run a pivot table so that you're able to analyze a large data set in more in-depth specific tranches analysis. So what we're going to try to do is determine the exit amounts based on first versus seconds and the senior lien status. So if I grab the data set that I want to analyze, we'll go all the way over to the state, just in case we want to break down the different states. And then what I'm going to do is right-click this. Actually, no. Go to Data, Summarize with Pivot Table. We're going to add it to a new worksheet. Click OK. Now you've got a blank slate here. You've got your pivot table fields on the right, and you've got your future pivot table on the left. So let's start out by taking, let's look at priority. Let's look at first versus seconds. So you throw that out into the rows. So now we've broken down first, seconds, and unsecured loans. And then we want to know, let's take the unpaid principal balance. Let's take the fair market value. And let's take, even the equity would be nice. We'll also grab, of course, the exit amount, because we want to see what these loans are selling for. All right, so we've got some fields summarized already. I want to see them in format that I can read. And now let's do a little bit of math on these to see what the percentages are. Now, one thing I want to mention right off the bat with pivot tables in the more recent versions of Excel, and it's a pain in the butt, but this is the workaround. If you click equals and you want to calculate one of these and you click it, well, let's say we want to do exit amount divided by UPB. You see how this gets inserted? And if I want to go divided by UPB, I get the right number, right? I get 14%. But what's annoying is I can't drag this down. It keeps repeating the same formula. So that's a pain in the butt. So what I would recommend when you're calculating pivot table details like this, go equals and actually just plug in the cell with your keyboard. E4 divided by B4. And then what that does is lets you drag it down and properly change from B4 to E4 to E5 to E6 to E7 to E8. So super important, especially if you've got a huge breakdown. So let's actually break it down a little further. Let's take current senior status and go under priority. So now we've got a little bit more data and we want to drag down the same percentage all the way down. All right, so now we've got even more information about the first and second liens broken down into senior status, and then of course the unsecured. So the first thing I do when I look at a pivot table like this, I want to organize these in priority. So current senior lien is the best, so that's good. Rolling 30 is the next best. That would mean they're 30 days late consistently. FC initiated, that should not be here. Let's drag that down to the bottom. That's probably the worst. Unknown, not reporting. Loan mod is more than likely current, so we'll put that right here. 30, 60, 90. All right, so that lines up. This is in order of preference, of order of priority. Current would be the best, foreclosure initiated would be the worst. So we can start to see a trend here. 40%, that's the high end for current seconds. Then it goes down for loan mods, presumably because some of these loan mods may be not reporting. It was a loan mod that wasn't recently reported. We go to rolling 30, a lower percentage, possibly because of the lower equity. Then we've got 30, 60, and 90, all at 40%. So that's interesting that even in this lower equity, actually all of these have a pretty substantial amount of equity, and that's really what drove these prices. And then we've got not reporting at 14, unknown at 9. Look at that, FC initiated at almost 20%. So there's always some different attributes that are hard to see in the pivot table. So if you wanted to further break this down, you could add some more detail here. We could take bankruptcy status, and I wouldn't want BK status to be below current status because there's less BK options. So I'd put BK before, and then we'll see the breakdown within each. So we've got subsets of first and seconds, subsets of the bankruptcy status, and then a third tier subset of the senior status. And you could keep this going. You could create pivot tables. Let's say we wanted to look at you can just drag them to delete them like that. Let's say we wanted to look at first versus seconds in each state. So we could do that as well and see a breakdown of every single state. We could see where the highest end pricing is, where the lowest end pricing. We can see right off the bat, Arkansas first lien, 61%. We've got a bunch of different things, and you could actually look at this in a much easier way. Oh, thanks, Nick. Remove the dollar from the cell link to drape down. I'm not sure what. Oh, I see what you're saying. If you go like this and take the same equation like this, what you can do is just delete these dollar signs. The dollar sign freezes the cell in a particular way. So delete that, delete that. Now if we drag it down, we'll get the correct result. Nope, see, Nick, it's still broken. I mean, it's very frustrating. That's why with these new pivot tables, and maybe your version of Excel is different, you can't just click in based on your equals. You really need to plug in the actual cell. But in any case, I wanted to show you one other trick, and that's conditional formatting. So if we wanted to see which one of these is the highest and which one is the lowest just at a glance, you use conditional formatting, color scales, and then we want to see green on the top. So green is high, red is low. And now we can see right at a glance those high-end prices, the darkest green. And then the lowest, unsecured loans, remember I told you we closed the deal at 1.9%, that's on the low end. 22.7% overall, that includes unsecured first and seconds combined. So very interesting to break down a portfolio by the pivot table, because you can just stratify it and slice and dice it in so many different ways. Now, one other way you can use this data, and I've already created a pivot table over here, is for reviewing each of the individual buyers. So actually I can build it for you here just so that we can show you exactly what we're doing. So I actually converted the buyer text, the names of the buyers, to wingdings so that they'd be confidential. But if I take, is it even in here? No, I do need to, I didn't capture that part of the spreadsheet when I created the pivot table. I'd need to capture the cells. But I've already done it here. I've taken the purchase entity name, the total exit amount, and the total UPB. So we can now see the percentages of the value that all of these different buyers are, and I don't want to click that because it actually shows you who's who. So in this case, we see that our top end was this buyer purchasing a single loan, and I didn't add that, but we could, if we go like this, move this over, and let's also, oops, I also want to add the count. So what I'll do for the count is take current UPB again, and then instead of total, we're just going to go count. And make that smaller. All right, so now we can see how many assets are in each of these portfolios. So my strongest buyer here is 60.98% buying one asset. And then we've got a blend. Let's see, the weakest was 4.14. They bought 40 loans. So you can see right off the bat why a portfolio was more attractive pricing-wise, because it was a larger buy, and presumably it was lower quality assets. So this is just a way that I will use to review what I've got available, what deals are pending, and there's some other things that we'll talk about in a more advanced episode in the future, where I can actually compare every single buyer offer across every single loan in this format. So I can see all of the competing offers on a single asset. And I use an index match for that process. It's kind of like VLOOKUP, which last episode we talked about VLOOKUP, which is a really cool, probably my favorite Excel formula in order to compare different spreadsheets that have a common delimiter, which in this case would be loan number. But then you can use a more powerful version of VLOOKUP, vertical lookup, called index, and then combine that with match in order to look up in different ways to find the buyer name at the top of the column, match that with the price that they're paying, and then combine that with the max offer so you can determine who had the max offer. So that'll be a future episode. It's kind of advanced in the sense that it's really only relevant for, well, it could be relevant in other ways, but it's mostly relevant for sellers of loans who are offering large portfolios with a lot of different buyers making offers. But that would be an interesting thing in the future. If you guys are interested, you can definitely leave it in the comment below, and we'll get to that at some point. So I hope you understand pivot tables just a little bit better. They're super cool because, like I said, they can allow you to analyze large data sets, and using things like that conditional formatting to visualize like a heat map almost of your data. But as long as you set it up with pivot tables, there's so much flexibility to slice and dice. So let's get on to assets for sale. And that's because we sort of already sort of already went through it a little bit because I showed you all of the pending offers that are out there right now. I've got a quick overview of the process. You guys have seen this before, but if you go to FIXnotes.com, click on Buy Notes, click Sign NDA for access, you'll go through this short form. Once you've completed this, you'll get an email for your login details so you can review the entire online course on FIXnotes.com/learn for free. And then you can also get your non-disclosure agreement to sign. Once you execute it, you'll get the signed document back in your inbox, plus a membership update. That membership update can be reviewed by clicking my account, making sure it says course plus inventory access. Once you do that, you'll now have a new page on Buy Notes, which will include a short video with some instructions, the letter of intent format. Really, you can send an email with the letter of intent, and then all the loans for sale. This is a bit outdated. We've got about 60 loans that are still available, and be happy to share with you any information, any questions you have about the current available inventory. I just updated it yesterday, or I think on Monday, with all of the potential pending deals. So you can not only see what's pending, but you can see what the pending amounts are. So you can start to hone in on maybe why you lost a bid or where you needed to be in order to acquire the asset. So definitely check out that on FIXnotes.com/buy. If you are already signed in and you click buy, it'll actually take you to FIXnotes.com/buy NDA. And that would give you the full access, a link to download the spreadsheet, and all of the confidential information since you've properly executed that non-disclosure agreement. All right, so let's get on with case studies here. Man, this is a long show. We're already into an hour. Thanks for hanging out with us, guys. All right, so this is the first case study, a non-performing first lien secured by a single-family home. This was a full payoff, a small one, $6,927, but nonetheless, we got a full payoff on this deal, and it was a fair market value of $90,000. Holy crap. I just had a huge branch fall out outside right now. Let's take a look at the cameras. The cameras are dead. The cameras are dead. Let's check on the koi. That's what happens when you stream for over an hour. Things start to go a little haywire. I don't know if you heard that, but a huge branch just fell right on my head on the roof up here. All right, so fair market value of $90,000. Taxes were 0, so we knew right off the bat the borrower had intentions of retaining the property. Unpaid principal balance of $6,146. Plus the arrears, it became $6,927. We asked 3 questions. What happened? Where are you now? What do you want to do? That frames the rest of our conversation, frames the rest of this borrower resolution process, because we want to know what's going on with the borrower, how we can help them. So what happened on this one? The borrower got behind on their loan but kept up with the taxes. Where are they now? Well, it's an owner-occupied property. It was on the market for $84,900. I really want to get this third camera up because there's a bunch of birds here, but let's focus on the content. We're already an hour into the show. Let's just stick with what we're here for. So the borrower was ready to sell the property, settle the loan, move to a more affordable housing option, probably moving in with somebody. Didn't get all the details there, but I know that this home, they wanted to get rid of it. So we received an email from the title agent in July. They told us they were preparing for the sale, and then they get back to us later that month to say the closing is set for August, we need your payoff quote. So the servicer payment details and the payment quote were sent to the title company for closing. And this was super seamless. It was an easy one because of the amount of equity in the deal. They want to close the home, settle the debt in full. Pretty simple. In this case though, we paid $3,600, just shy of 60% of the UPB, because this was one where it was capped by the unpaid principal balance. Like I said, in first liens, you're pricing based on fair market value, but with that consideration of the unpaid principal balance, this would have been a lot more as a one-off deal, because really, it doesn't make a lot of sense for an investor to sell a deal like this unless they really need the proceeds. But this was purchased bank direct in a bulk trade. So the price was less than 60% of the unpaid principal balance. It took 11 months, and we went from the due diligence to the onboarding to the collection process with about $620 worth of expenses. And that brought us to the point where the title company requested that payoff quote, got us paid, closed the deal for the UPB plus the arrears. Rakesh, even though I know these tools, the way you share the application of them is very valuable. Really appreciate the kind words, Rakesh, and thank you for sticking around for this long episode. So this deal, let's talk about the takeaways here. First of all, send monthly, and I say payments here, I meant send monthly statements to establish urgency. You need to account for the arrears on a monthly basis so the borrower understands that this is a debt that's going to continue to grow if they don't pay it off. Now, we mentioned this in the previous episode about charged off loans. Charged off loans, when they are not receiving statements in the borrower's or the bank's charge-off process, do not continue to accrue interest. But once the loan is boarded with your loan servicer, make sure that you're preparing those monthly statements while your servicer is preparing and sending them so the borrower is fully aware of that increasing payoff balance on a month-to-month basis. Next, encourage a resolution that most benefits the homeowner. I see this time and time again where an investor will try to drive a square peg into a round hole, and they think that there's going to be some resolution that's based on their terms. It's not based on your terms, it's based on the borrower's terms. And that's why we start every conversation with what happened, where are you now, and what do you want to do. So in this case, a much better resolution, it's not even a resolution, but a much better deal for the investor would be if there was a foreclosure, we took back a home worth $90,000. I mean, that's just unrealistic. So you need to work with the borrower with the resolution that most benefits them. And in this case, it was a property sale, we get a full payoff, everybody's happy. Now, another point to note here is to monitor property taxes for the borrower's intentions and your risk as a first position lien holder. Just like we look at the first lien status in second position, look at the property taxes in first position to understand the borrower's intentions. If they're paying the property taxes, you know they want to keep the home and they really just need to be negotiated with and then come to some resolution to resolve the other debts on the account. And then finally, the velocity of money. A payoff offers much higher returns than a modification. And in this case, it might have seemed nice if the borrower wanted to start a payment plan. We'd earn some interest in the long run. They were plenty protected by equity. It could have been a good reperforming loan. But when you look at the time value of money, the internal rate of return is astronomically higher when you get the payoff early. And in this case, the payoff was the resolution. We didn't have to do a mod. We got our full payoff and move on to the next deal. And with that, we'll move on to the next deal. All right, so the second one is a non-performing second lien secured by a single-family residential home as well. And this one was closed with a modification, resulting in a reperforming loan value of $25,125. So right off the bat, the fair market value on this deal was $489,500. The senior was $410, so that leaves $78,000 of equity protecting our $31,000 unpaid principal balance. This is pretty much as good as it can get in second position. Plenty of equity and a current senior lien. So we asked those three questions. What happened, where are you now, what do you want to do? The borrower hit a rough patch. They're self-employed and their business was not doing so well and they got behind on both of their mortgages. So I was actually wrong on this. The senior was not current, but there was enough equity to support it. Now, when you have a non-performing senior though, as that senior goes further and further delinquent, your equity position can be threatened. So even though this was an equity account at the purchase, it could have quickly changed as fair market values change and the senior status, senior balance could have increased. Where are they now? Well, they're 60 days late on their senior, but they are working to bring it current. The business is picking up, but they can't pay more than the original monthly payment, which was $352 per month. They did agree to a payment plan in January. We're able to make contact pretty soon after purchasing the loan, but then the borrower disappeared for months. We did renew that conversation in July, and we made sure to explain that it's been months since our previous options were available. We need a down payment, and we need to start a monthly payment close to that $352 you expected. So we did agree to a $1,000 down payment, $350 per month, a fixed rate modification at less than a 6% interest rate. So typically we start all of our modification conversations at 8.75% interest, and then we work with the borrower based on their situation, based on the negotiation, how much they're going to push back on that higher rate. But at the end of the day, we're justified to offer a higher rate because these are borrowers who have lower credit scores, they're in default, they're more risky, the rates have to be higher. And the goal is though to let them refinance those loans in the future. So we never require any prepayment penalty. So while the rates may be higher, the borrower and the investor are on the same page to get that early payoff, which jacks up the internal rate of return significantly. So in this case, $9,500, around 30% of the UPB was the purchase price, and it wasn't 60% because the senior was delinquent, but this could have quickly became 30, 40, 50, 60% of value, 60% of the unpaid principal balance if the senior was current and the equity position was going the opposite way, increasing. In this case, it took us 10 months and $340 of expenses. The expenses were lower here because this was a second position lien, so the due diligence cost was a lot less than that first case study we discussed. Due diligence, onboarding, collections, and mod fee, not too expensive, but it was quite a bit of time kind of doing the hand-to-hand with the borrower because of the disappearance in January after we had already came to an agreement. So that results in a reperforming loan value of $25,125. It's a 16% cash-on-cash return to a reperforming loan buyer at that price. If you plug these numbers into the spreadsheet we showed earlier in the episode, you can review how that works out mathematically. And it offers 100% plus internal rate of return for the non-performing loan investor who does the fix and flip. If you bought the loan for $9,500, spend 11 months working with it, get it cash flowing, and then waiting for seasoning. So it's definitely more than 100%. I believe if we did it with the 10-month timeline, which is unrealistic because you would not sell the reperforming loan the month it's modified. You need a couple months under the borrower's belt of consistent payments. So that would probably extend our full life cycle on this to maybe 15, 16 months. It's still above 100% internal rate of return if you sell that for $25,000 as a fix and flip non-performing loan investor. So a couple takeaways here. Let's start with the first one. Present options as non-negotiable and then allow flexibility when you can. And really what I'm alluding to is that higher interest rate. We put together an 8.75% interest rate option, and then some borrowers, they want to move forward, they want to get the loan modified, and that's okay. Other borrowers are going to push and prod, and in this case, because the equity position was strong, we had some leverage, but because their first lien was also in a tricky spot, we did offer a concession there and reduce the interest rate. Now, good cop, bad cop, it's a proven strategy, but you do it in the right way and it can actually benefit the borrower. So the good cop is the resolution specialist. That's the person, the team who's actually doing the collections work, who's asking those questions, what happened, where you know, what do you want to do? And then the bad cop is the investment committee. And that's where all of the deals flow through. So when you're communicating with the borrower and they say, well, I can't pay an 8.75% interest rate, you tell them, all right, well, we're going to confer with the investment committee and see if we can get a lower rate approved. I'm going to do everything that I can for you, but at the end of the day, it's the investment committee's decision. So that aligns you as the good cap, the resolution specialist, aligns you with the borrower as their advocate, their teammate, and then pits you guys against the investment committee so that if there is some numbers that don't work at the end of the day, you can still have that positive rapport with the borrower while also rejecting a deal because the investment committee would not allow it based on the numbers, which you can find out those numbers by looking at the spreadsheet we talked about earlier, linked in the description below, to determine what the minimum monthly payment is that you could accept. All right, another takeaway here, respond and follow up promptly via the borrower's preferred communication. This borrower was a little finicky. They didn't want to communicate via email. They wanted to talk on the phone, but they didn't want any documents sent to them via email or text or anything. They wanted everything mailed. And by the way, FedEx was not good enough. They wanted it mailed via USPS. So this was a little bit of a hurdle to overcome because typically I like to move in the most efficient ways. Sharing documents and communication via email is just so much faster and easier to work with. But you got to work with the borrower with their preferred form of communication. And in this case, it was sending letters via USPS with all of the documentation that they needed to sign to modify the loan. Next is to respect the borrower's needs for authentication. This borrower, like I said, they were a little bit finicky and they wanted to make sure that everything was correct, that the assignments were recorded, that we were the vested lender on title, that everything was clear so that they weren't getting burned or it wasn't subject to some fraudulent practice. So respect that because these borrowers a lot of times haven't heard from a lender in years or they haven't really communicated about this loan in quite some time. So to authentify yourself with assignments of mortgage and other documents, super important, and really at the end of the day, it's what's called a QWR, a qualified written response, and that's what a borrower will first, if the borrower has an attorney involved, that's the first roadblock that they'll throw up. They want to see the original note, mortgage, assignment, allonge, all the documents in order so that they can confirm the validity of the debt. So you have to respect that, work with them, make sure they get comfortable with it, and that'll help you overcome that hurdle to actually modify or resolve a loan. And then finally, communicate professionally, solidify that legitimacy. Make sure you have in your email signature the mini Miranda. If you're communicating via email, make sure that everything is very clear. You've got a licensed servicer in place, statements are being sent promptly, everything is legitimate and authenticated. So super important to get your assignments recorded right away because that's going to be a roadblock that a borrower could throw up pretty early. And until you have your assignments recorded, there's nothing in the public record that's showing that you are the vested lien holder. All right, so that's it for this case study. I think that's it for the show. Next is giveaways. Of course, I'm changing up giveaways just a little bit. We're still offering 15-minute consultations, but I've been offering 15-minute consultations for free forever. So your first call, I'd be happy to talk to you. Whatever you want to talk about, whether it's specifically note investing, specifically deals that you're working. I do charge an hourly rate for consulting, but the first 15 minutes, be happy to chat, get to know you, and see how we can work together. And because I'm offering this to everybody, not just awarding specific investors or specific commenters every week, I would still really, really appreciate it if you guys subscribe to the channel, like this video, leave a comment after the video is over. The live chat is awesome, but the comments that are left once the video is published do stick around so that other investors can see maybe a comment or a question that you had would benefit them. And it helps the YouTube algorithm immensely to subscribe, like, and comment. So please do that if you get any value at all. It supports the channel so much. I really appreciate it. And I'd be happy to get on these 15-minute consultations. You can book me at robbymax.com. robbymax.youcanbookme.com. It'll give you my calendar and you can pick a time and we can set up a 15-minute consultation. And then once we've passed 15 minutes, my wife has given me explicit instructions to start the clock and send you a bill for that. So 15 minutes is free, and I'd be happy to talk to you guys with whatever topic you want to help you most successfully get into this business or work out a specific deal or specific situation that you have. All right, thank you so much for watching, guys. This show, I have so much fun presenting every week. I thought I was a little bit off my game last week, but with this show, we're an hour and 20 minutes in. I think we've got a lot of great content. So let's close it with our favorite time of the day. Go feed the koi. Let's make sure the camera's still working. Wait, there we go. Yes, the camera's on, but the fish, they're hungry. They're hungry. They're waiting for me. So I'm going to set my macro. It's going to switch over to, it's going to switch over to the other camera, take off my mic, and we'll go feed the koi to wrap up the show. Thank you so much again for joining us. And until next time, until next Wednesday, I'll see you later. Best of success to all of you. All right, let me make sure I'm doing this all right. All right, one moment. All right, fish, time to eat. Thanks again for joining us, guys. Let's get these fish ready for winter. So since the seasons are changing, we had to change our food from a higher protein to a lower protein, like a higher, has like a little bit of wheat and stuff in it instead of the fish meal, because these fish cannot digest food below 50 degrees water temperature. So we feed them a little bit less, lower protein food, and they'll get ready to hibernate all winter long. Apparently, and this is going to be our first winter with these fish, apparently they're going to still, when the water's not frozen solid, come up and beg for some food. And we have to do our best to hold firm. You can't feed them when it gets too cold. So we're trying to get the most of it now while they're all active and hungry. My wife has been training them to like come into her hand. Let's see if I can get one. Oh, they're really sweet. We really love these fish, and we didn't even realize it when we bought the house. that that we would get so much joy out of them. And actually, when we bought the house, there was only one fish, one koi. There was a bunch of goldfish, and we'll see if we can get him. He's the big guy. You've seen him before. Oh, here he comes. This is the original fish right here. Come on, dude. Can you get in the camera? And we picked up the other 14 koi out in past Lancaster, Pennsylvania. And we hand-picked every single one of these little fish. So, needless to say, we love them very much. Probably more than the birds. Alright guys, thank you so much for joining us again for this Wednesday's episode. Please feel free to join me on October 10th. I'll be presenting at the Distressed Note Convention. Now, I will be honest, a lot of that content you guys have probably already seen. I'm presenting two topics, first versus second liens, and how to earn while you learn at this event that I've already presented on the show. I'm going to try to add some more case studies, some more interesting things for those of you who do tune in for this event that's coming up. But I did already present it all, so if you've got something better to do, and you've already watched the YouTube videos on first versus seconds and earning while you learn, maybe you could do some due diligence, analyze some assets in that time instead. All right, feel free to enjoy the fish for a bit. I'm gonna turn off the stream in just a moment, and enjoy the rest of your day, guys. It's a beautiful day here in the Philadelphia area. Hope you guys are well wherever you're tuning in from. Thanks again.